Okay, welcome to lesson number 9 in the Trading with Market and Volume Profile course. We're going to be talking specifically now about the TPO chart elements. So those are going to be unique characteristics or things that we're going to be looking for when we are observing the TPO charts. So first one we're going to talk about is what we called failed auctions. So we considered an auction failed when market breaks above or below an initial balance, but it fails to sustain the breakout. So in general, if market fails to hold longer than a 30-minute period outside of the initial balance and come back inside within it, we can expect the other side of the initial balance to be tested. Okay, and this is very similar to the concept of inside bars. This is something that I talk about in my other courses, and I've had YouTube videos on it as well, where, let me just put in the black screen here, or I'll just write here on top of this screen. So the inside day, basically, let me put up the Sierra chart and move this out of the way so I can have a little blackboard. So the inside day is basically when we have one candle, for example, and then the candle next to it is going to be a candle that is contained within the entire range of the previous candle. This can be applied to anything. We have inside week, inside day. Those are the two main types, but probably inside day is the most used using the daily time frame. So when we have this, there's two scenarios that we look for. If on the third or fourth day, whichever it is, if market comes up and prints a daily candle through the outside, in this case through the top level from this inside day, this is an indication that market is probably going to start trending in this direction. The opposite of this is what we call a failed inside day breakout, where if we had market opening, but then all we have is we leave a wick. So basically we have a false breakout from, in this case, the top of this inside day range here, then we expect market to go down and visit the underside of this range. Okay, so that's the inside day pattern. You can check back. I'll put a link in the description here for the inside day video that I have on YouTube, or if you're already in my other courses, I have a more detailed version of that as well in there. But basically that is the concept of the inside day. And so the failed auction is very similar, but what we're using as a base is the opening range. So the first 1 hour of trading in whatever market you're looking at, but mostly I apply this in the futures market. So from 9:30 to 10:30, we established the initial balance. And then you can see right here, market came down. We tried to wick a couple of times to look like this was going to be breaking down. And yet we kept holding this level. And then market eventually put in over-under pattern. Here is one of my favorite price action patterns, where we put in a left shoulder, then a low, and then a right shoulder, and we held. And then you can see eventually we did push up and break above the other side, or we visited the other side of the initial balance. Okay, and we can see the example here from this same 3000 tick chart, but looking at it in a market or TPO chart. We have the initial balance here with the A and the B period, so the first hour of trading of the day. And then you can see right here on the C period, on the third period, we have the false breakdown. Then we come back above, and you can see we go and visit the other side of the top side of the initial balance. Okay. So next element we're going to look at is excess or tails. So an excess or tail are seen at the top and bottoms of TPO charts. If we look at a 30-minute candlestick chart, the tails are seen as large wicks. A large buying tail means that responsive buyers are coming in below value. A large selling tail means that responsive sellers have come in above value. The bigger the tail, then there is a stronger conviction. Excess or tails should be over 2 TPO periods long, okay? And this is an important factor to take into account, as we're going to see in the examples coming up. These tails are best when identified as significant market structure areas, like a previous day high or low, last week high or low, maybe an important swing point at a naked point of control, or high volume node edges on volume profiles, for example, which I've talked about. These are, for me, the best areas to look for entries with trends. A great tool to use in confidence will be a footprint chart, as this lets us identify absorption areas. So for example, a big buying tail left after testing the previous day low with lots of aggressive sellers caught at the bottom of the tail indicates a strong chance for a reversal, at least in the short term, okay? And we're going to see a few examples here. So you can see this is a Euro US dollar chart. On the left here, we have a 30-minute candlestick chart. And so this whole days here is what we're representing right here. This is the regular TPO. This is the split TPO. So we can see the development just like the candlesticks. And you can see right here, we had this low from the previous day right here. And we came and we left a big wick, and we had a failed breakdown, a swing failure pattern from these lows right here. So this is a nice buying tail that we left over on here, okay? And remember what we mentioned, in order to be considered a tail, it needs to be at least 2 prints or more bigger. So for example, here, this is not a tail, because as you can see, all we have is one little print, and then next to it another print one lower. So there was no real excess on here. This one is barely a little tail. We have 3 prints here, but then on this one you can see that on the top and especially on the bottom, we did leave some very nice clean single print tails on this profile. Okay, and here's an example what I was talking about, the footprint chart. Again, this is more related to order flow trading, with it's not in the compass of this course, but I do have my day trading course where I talk a lot about strategies to do with this, and we can see what we are talking about here. For example, here we had the extended hour session with the low right here. Then when the regular market opened, we had a very quick flush down where we broke below this low, and then we had a very strong reaction up. And I took a screenshot of what the footprint looked like right here, and you can see how I have here this purple highlights represent medium volumes, and this orange represents very high volumes. This is a volume by delta footprint chart. So on the right side, all the green numbers represent more aggressive buyers than sellers, and the red ones more aggressive sellers than buyers. And you can see how right at the bottom of this wick, we have this area right here, especially this candle here. Very high volumes of aggressive sellers that once the market started pushing up, and you can see now big buying aggressive buyers coming in. As soon as this pushes away, we have a lot of traders that are caught short underwater. Market reverses them, and they're probably going to be stopped out or forced to get out of their shorts, adding to the fuel of the buying reversal here. So you can see how a big tail down, in this case at a significant low level, can indicate a possible reversal is coming on. Then we have poor highs and poor lows. So these are the opposite of excess. They're considered an inefficient auction, leaving flat looking highs or lows on the profile. It shows lack of confidence in the market for momentum and signals that other time frame traders or the big players are not stepping in to push out of value. These edges are considered unstable and are often revisited by price to get repaired. They are identified as TPOs with 2 or more blocks or letters at the same price level, at the same high or low. So for example here, you can see on this profiles, we have this one's this is from the screenshot that just got cut off, so don't pay attention to these bottoms. But right over here, you can see here we have a little excess tail, but in this case, on these two profiles, we have 2 TPO prints or 2 30-minute periods at the exact same price. So this is what we would call poor highs, and then this is going to be important reference points because market will tend to come and hit those levels to do what we would call repair those levels. If we look at them on the candlestick chart, this poor highs and lows are going to look like double or triple highs or lows. And we can expect a lot of rest in liquidity just beyond these levels, hence why they're targets for repairs. So, you know, if you follow any of like what's called the smart money concepts or things like that, you know that people say when you have double tops and bottoms, etc., that most likely we got a lot in this case of stops from people that went short. So we have a lot of resting orders to buy at these levels, and then they say that the market is going to be attracted to liquidity. So in this case, you can see like right here, this market opened up on this day, and then we had a strong push up to seek out or repair, in this case, this poor highs and lows. Okay, and now we're looking at an example here on the chart, and you can see this is a 30-minute candlestick chart, and we had on this trading day, this market made a double bottom right here. We have 2 candles with the 2 wicks exactly at the same price level, and you can see it represented here when actually this third one was almost at the exact level as well. So you can see we had a very flat bottom here. There was no excess like we had on the top on the bottom, and then you can see the market just came down, did a flush, and then repaired this poor lows that we had right over here. So this was a very clear target when this market opened. You can see we did go up and pushed up, but as soon as market structure was broken here and we started trending down, these lows were the first immediate target point where we would have been focusing on over here. Okay, and here's another example. Same thing, we have a 30-minute chart, and you can see right here double bottom here represented by two periods here, two TPOs side by side. So we have here the extension, and then you can see on this day we had a very bearish day here. We had an open here and a close here, but on this flush down we came and repaired the poor low, and then we actually left a pretty large excess tail to the downside. So this wick right here represents this area right over here. So it will be interesting to have looked at the footprint here to see if there's any trapped late shorters on this area. But the main thing is you can see how we have this poor low level, and then the market here came down, broke market structure, pulled back, almost retested this, and then just a very impulsive move down. And, you know, in this case, first we would target these lows, and then immediately after we have this poor lows down at this level. Next, we're going to talk about singles. So single prints are the same as X's, but they occur within a profile. So you could consider this as common gaps. They originate due to impulsive price moves. So they're seen as just a single TPO column inside of the TPO profile, because obviously if we have singles on the edges, that's what we would call excess tails. When we talk about singles, we're looking for single TPO period prints inside of the profile. In volume profile terms, this will be the equivalent of what we talked about of low volume nodes. So in this case, we have this nodes right here, and this will be what we would call a low volume node area. So in this case, this level and this level would be important levels of support and resistance that we should be tracking in here. Okay, they are great areas for targets as well as areas for support and resistance. They're mostly seen on trending days when there are lots of impulsive moves. So here's a few examples. We have this market here where we had a very impulsive move up, and you can see once we had this, we left this single prints right here on this profile, and then you can see on the next day the market started trending down aggressively, and the first area that was targeted here as far as the test was first this broken swing high, which coincided right with the singles print. So if you're familiar too with more smart money concepts, as they're called, and everything, what's called like a fair value gap, for example, would be exactly what we know as a single print. Okay, here's another example. We have a chart here. Market came down, and then we had a very aggressive move down, leaving this gap right here, which is exactly this right here. Okay, and you can see how then we have the singles extension line. Then the next day, right over here, which will be right here and right here, this is the same profile, just one is split and one is regular. I like to always show you, the regular and the split side by side, just so you learn how to split it up and just use it to track the market movement. But again, same thing as if you were looking at a 30-minute chart as well. But you can see how this market opened. We pushed down, came back up, and then in this case, the first obvious target would be filling in this impulsive move and this gap down with the single print left at exactly the point of release or the point of the breakdown. and you can see how we came and hit it and actually had a pretty significant reaction off of it right here on this pullback. So if you're day trading, you know, this could have been a very nice opportunity here to get short. But you can see how single prints are seen all the time, especially in trending markets, and they represent excellent target points. Here's another example, more for like, you know, if you're like a swing trader. We had this very bullish day here, which opened down here and closed here. Market trended up slightly, then we started breaking down, and you can see right here how we had these two single prints that were left from this bullish day that had not been filled yet, and then market came. So this would have been important target areas to have, you know, to be tracking once you identified that this market was trending downwards. Here's another example. We had this large resistance. You can see for 2 days, market failed to break above this line. Then here on this day, we had our break to the upside right here. We left singles at this level. And you know, if you're looking at a chart, it's very easy to identify the singles, because basically anytime you see a candle with no overlapping wicks or other candles on either side, then that is what's going to be a single print, which is exactly what smart money concepts would call a fair value gap. That is exactly what a single print is. And you can see right here, the market actually gapped down directly into this single print fill. Then we tested the broken resistance. It held that support, and then we just pushed up from there. Okay, but single prints are very prone again to get filled in the next day or the next session. So I always track them when I am in my trading. Now let's talk about ledges. So ledges are seen as poor highs or lows, but they occur within the TPO profile. It represents areas of support and resistance where price had 2 or more periods at the same price. These areas work great to play support and resistance flip for continuations. You can think of them as swing levels that are broken, and we can look for retests. Okay, so basically pure market structure concepts where market is trending, we have a resistance, then we break it, and then we expect a retest of this resistance, and then potentially market to make a higher low in order to then continue the trending environment. So in this case, this broken level, if we have 2 or more TPO periods on this area, then we expect, this is what we will call the ledge, and then we can expect a retest of it. And we can see it on this profile. Here we have a 30-minute chart. We have this swing high with 2 TPOs at the same levels. Market breaks above. We have our pullback into it and our continuation. So you can see right here, market just higher highs, higher lows, okay? And you can see it on the TPO. If we split it up, we have 2 TPOs here at the same level. Market breaks above, come back to test it, and then we continue in the direction of the breakout. Okay? And here's another example. This is a 30-minute chart again zoomed in. You have these 2 wicks at the same price levels. Market then comes and breaks down, and immediately on the next candle we push up and retest that ledge and continue pushing down. and you can see it on the TPO. Right over here, we had the ledge here of support. It is broken. Then this period closes. And then we push right into this ledge to continue down. Now you can see we did end up reversing afterwards. But again, if you're day trading, this could have given you an opportunity for a nice quick trade. Okay, and that's pretty much it. Again, this is all TPO chart elements. I recommend, you go into your Sierra chart or whatever platform you use, TradingView, etc., and just go back on the charts and learn to identify all these levels. So, for example, right here, you can identify we had a poor high right here that got immediately fixed at the opening of the next trading day. This is the daily profiles for the ES futures market. Here we had a single print from this impulsive move, and we can actually split this profile so you can see this single prints were left right over here towards the end of the day when we had this big impulsive move up. So then that leaves a single right over here on the release point of this market. And you can see how the next day market opened and literally the low of the day was the fill from this singles into the breakout point right over here. For example, we have a poor high here actually, so that will be a level that we're going to track in the future. There's functions here on this platform, so you can see that this level was actually repaired 2 days later right over here. For this, if you go in the settings for this indicators, there's options. For example, here, extend singles. I can put until future intersection, extend poor high low until future intersection. So what this is going to do, it's going to extend this until the next time that these levels are touched. So you can see, for example, right here, this poor high, we had this extension line up until the next time is tested. This poor high, extension until the next time is tested. So this is just, useful things to have in order for you to be able to follow these markets here. The pink lines are single extensions. So you can see we had singles right here, singles right here. So then we have our extension lines here, and then you can see on this day the market was strongly trending down. Then this could be very clear targets that we will be looking for on this. Okay, so that's pretty much it for the video, and I'll see you all in the next lesson.